Wake up, it's the first of the month. I brush my teeth and count up.
Dutch Lady Meat Industries. This company is an established market leader, founded in 1963. It remains a key pillar of Malaysia's dairy sector and a proud subsidiary of Royal Franceland Campina. One of their greatest strengths is their extensive reach. The company maintains a powerful brand presence and a distribution network that spans the entire domestic market. Their diverse portfolio is another core advantage, with products strategically segmented to meet nutritional needs across all life stages, from infants to adults. From a performance perspective, their established position drives a financial profile defined by scale, stability, and high sales volume. Finally, through continuous investment in product fortification and marketing, Dutch Lady has successfully secured its status as a trusted household name. Now, let's look at Farmfresh Berhad, which acts as a modern disruptor in the industry. They are a consumer-centric brand focused on a farm-to-table philosophy and local freshness. They have successfully carved out a distinct market niche, capturing health-conscious consumers through short supply chains and a perception of natural quality. We can see their rapid portfolio expansion as the company goes aggressively into plant-based alternatives, ice cream, and ready-to-drink beverages. This growth-oriented strategy shapes their financial structure, requiring significant investment in production capacity and brand building. Ultimately, unlike more established players, Farmfresh must balance aggressive market capture with the pursuit of long-term sustainable profitability.
The first financial statement analysis that we will do is the liquidity ratios. Liquidity refers to a company's ability to meet its short-term obligation by using their current assets. And to analyze liquidity, we will use two ratios, which are the current ratios and the quick ratios. First, for Dutch Lady Milk Berhad, the current ratios is 0.81 to 1, which means that every 1 ringgit of their current liabilities, Dutch Lady only have 83 cents of their current asset. And since the ratio is below 1, it indicates that Dutch Lady may face some difficulties in meeting its short-term obligation. And second, the quick ratios for Dutch Lady is 0.36 to 1, which shows that Dutch Lady only have 37 cents worth of liquid asset for their every 1 ringgit of current liabilities. This quick ratio suggests that Dutch Lady has limited liquidity assets to cover its short-term debt.
For profitability, the ratio we use net profit margin, gross profit margin, return on asset, and return on capital employed. For net profit margin, we use the formula net profit over revenue times with 100. And for gross profit margin, we use the formula gross profit over revenue times with 100. Net profit margin, we get the value of net profit margin 6.69% and gross profit margin 33.77%. For net profit margin, it indicates for every 1 ringgit sales, Dutch Lady Milk Industry Berhad can generate 7 cents worth of net profit. For gross profit margin, it indicates for every 1 ringgit sales, Dutch Lady Milk Industry Berhad can generate 33 cents of gross profit. Okay, next, return on asset and return on capital employed. Return on asset, we use the formula net profit over total asset times with 100. And return on capital employed, earning before interest tax over capital employed times with 100. For return on asset, we get the value 9%, and return on capital employed, we get 21.8%. Return on asset indicates for every 1 ringgit asset, Dutch Lady Milk Industry Berhad can generate 9 cents, while return on capital employed indicates for every 1 ringgit sales, Dutch Lady Milk Industries Berhad can generate up to 22 cents worth of operating profit.
Now I'll be presenting about the efficiency ratio for Dutch Ready Meat Industry Berhad. Efficiency ratio evaluates how effectively the company manages its inventory, receivable and total asset. First, Dutch Ready records an inventory turnover of 4.01 times. This means the company is able to sell and replace its inventory slightly more than 4 times within the year. This indicates strong inventory management, which is crucial in the dairy industry due to the perishable nature of its products. Next, the average collection period for Dutch Lady is approximately 27 days. This shows that the company collects payment from its customers relatively quickly, improving cash flow and reducing the risk of overdue receivables. Lastly, Dutch Lady has a total asset turnover of 0.1238. This means that for every 1 ringgit invested in asset, the company generates around 12 cents in sales, reflecting efficient utilization of its asset base. Overall, Dutch Lady demonstrates strong operational efficiency through effective inventory control, fast receivable collection, and efficient asset utilization.
I will now present the leverage analysis, which examines the company's use of debt in its capital structure. First, the debt ratio stands at 53.26%, indicating that over half of the company's assets are financed by liabilities, reflecting a moderate and balanced use of debt. Moving to the debt to equity ratio, which is 113.94%, this means for every ringgit of equity, the company uses RM 1 ringgit 0.14 of debt. Creditors contribute excess debt of shareholders, which can enhance returns but also introduce financial risk. Finally, the time interest earned ratio is 18.62. This shows the company's earning cover its interest expenses nearly 19 times over, demonstrating a very strong ability to service its debt. In summary, the company employs significant debt financing, but its high interest coverage indicates a robust and manageable financial position.
Next, we will do the liquidity ratios for Farm Fresh Berhad. First, for current ratios, they have 2.93 to 1, which shows that Farm Fresh has 2 ringgit and 93 cents of their current asset for every 1 ringgit of their current liabilities. This indicates a very strong short-term financial position. And for the quick ratios, Farm Fresh has 2.01 to 1, and which means that for every 1 ringgit of their current liabilities, Farm Fresh has 2 ringgit and 1 cent worth of liquid assets. This also shows that without even relying on their inventory, Farm Fresh is still able to comfortably meet its short-term obligation.
Next, profitability for Farm Fresh. We use the same formula and we get net profit margin equals to 7.81% and gross profit margin 26.66%. Net profit margin indicates for every 1 ringgit sales, Farm Fresh Berhad can generate 8 cents worth of net profit. And gross profit margin indicates for every 1 ringgit sales, Farm Fresh Berhad can generate 27 cents worth of gross profit. Okay, next, return on asset and return on capital employed. We get return on asset 4.95% and return on capital employed 6.22%. Return on asset indicates for every 1 ringgit asset, Farm Fresh Berhad can generate 5 cents, while return on capital employed for every 1 ringgit sales, Farm Fresh Berhad can generate up to 6 cents worth of operating profit.
Next, I will explain the efficiency performance of Farm Fresh Berhad. Farm Fresh record an inventory turnover of 3.60 times. This indicates that the company replaces its inventory about 3.5 times during the year. While this shows acceptable, inventory movement, it is slower compared to a more established competitor, suggesting room for improvement in inventory management. The average collection period for farm fresh is around 69 days. This relatively long collection period suggests slower receivable collection, which may put pressure on cash flow, especially as the company continues to expand its operation. In terms of asset utilization, Farm Fresh record a total asset turnover of 0.05897. This means that for every 1 ringgit of asset, the company generates approximately 6 cents in sales. The lower ratio indicates that Farm Fresh assets are not yet fully utilized, which is common for a company in its growth and expansion phase. In summary, Farm Fresh efficiency ratio reflect a growing company that has invested heavily in asset but has yet to fully translate those investments into high sales efficiency.
Turning now to Farm Fresh financial leverage, which reveals how the company balances its funding between debt and equity. A key observation is the debt ratio of 45.84%. This tells us that less than half of the company's assets are financed through liabilities, positioning Farm Fresh with a relatively conservative capital structure. When we look at the debt to equity ratio of 84.65%, this translates to RM0.85 of debt for every RM1 of equity. In other words, investor capital plays a larger role than creditor financing. This often signals a more equity-reliant, lower-risk financial approach. On the solvency side, the time interest earn ratio comes in at 4.09. This means operating earning cover interest obligation just over 4 times, while adequate is a more modest buffer than some peers, suggesting that interest coverage should be watched closely. To summarize, Farm Fresh operates with moderate debt reliance and a stronger equity base, though its interest coverage is tighter.
Now we will do the performance comparison between Dutch Lady and Farm Fresh. And first, we will do the liquidity performance. We will start with current ratios. And this shows that Farm Fresh records a much higher value compared to Dutch Lady. This indicates that Farm Fresh has a stronger ability to cover their short-term liabilities using their current assets, while Dutch Lady has lower ratios suggests that they have a weaker short-term liquidity position. Moving to the quick ratios, the difference become more significant. Farm Fresh again shows a higher quick ratios, which means that liquid assets available to meet the short-term obligation without relying on inventory. In contrast, Dutch Lady has a very low quick ratios, indicating the limited immediate liquidity. And when we compare both ratios together, Farm Fresh consistently outperformed the Dutch Lady in terms of liquidity. This shows that Farm Fresh is financially stronger in short term and faces lower liquidity risk. And overall, Farm Fresh has a better liquidity, indicating a stronger short-term financial position compared to Dutch Lady Big Industries Berhad.
For profitability, we compare of 4 elements: Dutch Lady Berhad and Farm Fresh. And from this table, we can see that the Dutch Lady have higher value on gross profit margin, return on assets, and return on capital employed more than Farm Fresh, while the net profit margin for Dutch Lady less than Farm Fresh. From this comparison, we can conclude that Dutch Lady outperforms more in asset utilization, even though Farm Fresh is stronger only in the net profitability.
After we investigate both companies' efficiency performance, now we need to compare. First, looking at inventory turnover, Dutch Lady record an inventory turnover of 4.01 times, while Farm Fresh record 3.60 times. This indicates that Dutch Lady sells its inventory faster, suggesting better inventory management and more efficient stock movement compared to Farm Fresh. Next, we compare the collection period. Dutch Lady has a collection period of 27 days, whereas Farm Fresh takes 69 days to collect its receivable. This shows that Dutch Lady is much faster in collecting payments from customers, which improve cash flow and reduce liquidity risk. Lastly, we look at the total asset turnover. Dutch Lady records an asset turnover of 0.1238 compared to Farm Fresh, which is 0.059897. This means Dutch Lady generates more sales for every ringgit of asset, indicating stronger overall asset utilization.
This side-by-side view of leverage ratio highlight the key strategic differences between Dutch Lady and Farm Fresh. Looking at the debt ratio, Dutch Lady stands at 53.26%, while Farm Fresh is lower at 45.84%. It indicates that Farm Fresh finances less of its assets with debt, suggesting a more conservative approach to leverage and potentially lower financial risk. In terms of debt to equity, the Lady ratio is 113.94%, meaning creditors contribute more than shareholder Farm Fresh at 84.65%. We relies more on equity, which often signals greater financial stability and less reliance on borrowed funds. The most striking difference is in interest coverage. The Lady ratio of over 18 times shows a strong ability to service debt from earning. Farm Fresh is about 4 times, has a narrower but still adequate coverage. In summary, while Farm Fresh maintains a more conservative debt profile, Dutch Lady demonstrates significantly strong earning coverage of its interest obligation. This suggests difference in strategic priorities. Farm Fresh priorities lower leverage, while Dutch Lady leverage its strong earning capacity to support higher debt.
Moving on to the overall performance, Dutch Lady Milk Industries Berhad demonstrates stronger profitability and operational efficiency. The company records a higher gross profit margin of 33.77%, as well as higher return on assets of 9% and return on capital employed of 21.80%, indicating more effective use of its assets and capital, despite Farm Fresh having higher net profit margin. In terms of efficiency, Dutch Lady shows faster inventory turnover, a shorter receivable collection period, and higher total asset turnover, reflecting stronger working capital management and overall operational performance. In comparison to Farm Fresh Berhad, it demonstrates strong liquidity and lower financial risk. The company records a higher current ratio of 2.93 and a quick ratio of 2.01, indicating a strong ability to meet short-term obligations and maintain short-term financial stability. In terms of leverage, Farm Fresh shows lower debt and debt-to-equity ratios of 45.84% and at 84.65%, respectively, reflecting lower reliance on debt financing and reduced financial risk. In conclusion, Farm Fresh Berhad demonstrates stronger liquidity and lower financial risk, while Dutch Lady Milk Industries Berhad outperforms in profitability efficiency and operational effectiveness. This reflects a clear trade-off between financial stability and return generation. Overall, risk-averse stakeholders may prefer Farm Fresh Berhad due to its strong liquidity and lower leverage, whereas return-oriented investors may favor Dutch Lady Milk Industries Berhad for its superior profitability and efficiency. The preferred company ultimately depends on stakeholder priorities.